my belief is that like at the index level, the Nasdaq 100 is coming to reflect the state of the global economy best in 2025 and beyond. The risk management tools that we sort of cater in day after day will grow naturally, and they have today.
Welcome to The Derivative by RCM Alternatives. Send it.
Hi, this is Nick.
I'm Kevin.
And we're here to talk about index options on The Derivative.
Hey guys, how are you?
I'm great. I'll start there. I'm doing really well. Thank you for having us on, Jeff.
Yeah.
I'm doing fabulous. Thanks, Jeff. Thanks for having us.
And where is everyone? I know Kevin lives somewhat near me here, Chicago area.
I am. I'm in Evanston, not far from you.
Love it.
And contrary to my accent, I am based in Manhattan South, better known as Miami.
That is becoming more and more of a thing, right? How are there too many? Is it getting to be too many finance folks down there?
Never had too many finance folks. I'd never say that. But indeed, when I turned up to Miami in back in the dark ages of 2018, I think the finance scene here was could best be described as parochial with a handful of hedge funds, and now it's flourishing with a lot more sophisticated derivatives users, and the market is moving accordingly. So yeah, we're enjoying the influx, and it's creating some interesting conversations down here for me. Some good happy hours to go to for sure.
Do the proper derivatives guys have to battle it out with the crypto bros?
I think they hang out at different bars. Honestly, I really do.
Love it. All right, so we've got the heads of index option sales and content here. So we can basically talk anything and everything index options, which is exciting. I want to start with Kevin, who gave a little bit. We had an event in Philly a while back, and Kevin gave a eloquent. Was it eloquent? It was something, but it was well thought out, kind of the evolution, how options evolution ties in with human evolution and societal evolution, from what I recall. Kevin, do you have some, can you recount some of that for us?
A little recap. I guess just to set the stage a little bit, when I think about like my role and content generally, I think there's sort of a bifurcated market. I think there's a great deal of content. A lot of it you put out that is very, very tailored for high-end and institutional end users. And the groups that RCM works with, that many of them also work with Nasdaq, eat that up. And then there is a great deal of content that goes out through different types of channels that I would say generally panders too low. And when I'm talking about that, I mean like the get rich quick stuff and really the things that do not properly explain the risk inherent in any market. And so I try to do something slightly different and to give the markets that we operate in, which there is of course complexity, a bit of approachability to that huge array there. I think there's a fat middle. And I try to give interesting spins whenever possible. And so that was something I tried to do with the Philly event. There are plenty of situations where I know I'm not going to be the smartest guy in the room, but if you can frame a conversation and then allow that dialogue to happen, which hopefully we're doing today, I think really interesting stuff happens. So my thinking there was about evolution broadly. And, this is the type of stuff that happens when you're walking the dog or whatever, taking a shower. And so conceptually, that's something that Nick's British brethren Darwin came up with in the middle of the 19th century. Nothing new. But then I think it applies like much more broadly than finches and the Galapagos or like giraffes with longer necks. And I think there are very, very meaningful parallels between life broadly and markets generally. And I think that's why so many people find them compelling. there's complexity, there's ups and downs to both, and there's systems where a whole bunch of different actors come together. And so my sort of thinking there was that humans are capable of amazing adaptation. And I gave an example that most certainly wouldn't be typically brought up in a derivative kind of focused conversation, but just the fact that we're as fetuses in what are we in? Whatever that pot is, and our lungs are wet, but we're able to
In the
breathe
uterus,
through an
I believe.
umbilical cord. What's that?
In the uterus? Yeah.
Yes, that's right. Men talking gestation now.
In the first 3 minutes of the pod. We're nailing it today, folks.
Yeah, we are. Anyway, like seconds after we're born, we adapt and we're able to breathe the way we are right now. And this stuff we take for granted. But then I think about markets and I think about the tremendous evolution that's happened in the, let's call it 25 years both of us have been in this business. Tremendous evolution. And I think about volatility in the context of what we do, but I also think that change is constant in life. And that's a little cliche. But again, another parallel with markets. And so, if that's the case, then we're talking about like rates of change and we're talking about technology and we're talking about transactions happening. And like, it just so I don't get too long winded, if I bring it all back home, my belief is that, like, at the index level, the Nasdaq 100 is coming to reflect the state of the global economy best in 2025 and beyond. And I work with the likes of Nick to help drive sticky assets into that headline index or vehicles designed to track it, like futures. And then I think as a direct sort of descendant of that, the risk management tools that we sort of cater in day after day will grow naturally, and they have today.
So is your team responsible for those ads like during March Madness where the ladies like, oh, and the AI and everything's inside of this? Or is that a QQQ product commercial?
That's a good question. And so that is Invesco driven. We have a very, very meaningful, when I say we, I'm talking NASDAQ. It's not just the index options group, but NASDAQ has a very significant relationship with Invesco. So that's their marketing dollars at work. But the awareness around that in particular, like just the fact that you're bringing it up, whatever, we're 6 months since that, speaks to the power of things like advertising.
It's fair to say that anything that's true of the Nasdaq 100 for the Qs is also true of the Nasdaq 100 for the NDX index options that Kevin and I spend our time with.
That's been a home run for everyone, right? QQQs. Like, could you have ever, NASDAQ in general, imagined such a, right, not just that product, but then the move by everyone into ETFs? Welcome sight, or did NASDAQ and you guys see some of that coming?
I have to imagine that there were people with NASDAQ that had big dreams. Are we beyond them now? The honest answer would probably be yes. The ETF, if memory serves, launched in 99. And so early on, it was certainly a very different product. The constituency, the revenues, the profitability. One of the points I think Nick and I make regularly is that, or at least internally, but hopefully externally too, is that this is a very much more mature index than it was at the Q's launch. Now, just so the audience is aware, the NASDAQ 100 as a tracking instrument and calculation has been around since 85. So there is a much richer history there. But as far as end users really finding it accessible outside of a futures or a few mutual fund wrappers, I doubt that 20, 25, 26 years ago when that product was launched, too many people thought we would be on the path that we are today. Honestly, it was part of my decision a handful of years ago to shift sort of the hat from uh, looking to grow the ecosystem around the S&P derivatives to the one I wear now, and I'm thinking about. I talked to you about this at a rooftop event you did, and previously I got a kid that's 10. You got a couple of kids, one in high school. And where are their passive assets likely to flow? What is the natural sort of benchmark for their generation? My belief is that that day in the sun, that dominant placeholder is coming for the Nasdaq 100. But maybe I'm just preaching to the choir here.
I don't think that's out of turn though, Kevin. Anyone I speak to under the age of 30 is definitely looking at growing when they get to grow in retirement savings to grow that within names that you see in the Nasdaq 100. And the Nasdaq 100 is a natural sort of embodiment of a number of the trends that folks are looking to get behind when it comes to investing those assets. So I definitely see that as a shift in the conversations I have, not even just inside my own work, but with friends and family.
How many people know it's the Nasdaq 100 mainly versus the Nasdaq Composite? Does anyone talk about the Composite anymore?
Nick, I'll let you take this one first, and then I'll follow up if you like.
The Nasdaq 100, in part due to follow this conversation, right? Like we started talking about the Nasdaq 100 because that's where you see the Q's ads, and that makes sense. Certainly, it's an area of focus for Kevin and I. The tradable instruments in the derivatives setting, if we're going to talk about this from the namesake of the podcast. Are Nasdaq 100 focused, and so I encourage folks to look at it through that lens. The Nasdaq Composite does indeed represent all the listed companies on our exchange, but the Nasdaq 100 provides this specific difference to its peers, and coming from twofold, coming from a country where the predominant equity index is a 100, so FTSE 100, and then also coming to a country with such a large, and I am American now, by the way. Been here for 7 years. But so I consider myself vaguely qualified to talk on both on both sides.
Yeah.
But
You and
coming to
John
a
Oliver.
country,
Yeah.
right, exactly,
Yeah.
with such a expansive and varied equity landscape, it kind of makes sense that there are these different indices doing different things, and Nasdaq 100 does a very specific thing. Kevin, your thoughts?
I echo that. I would say indices, there has been an outgrowth of indices for many years now. And at a corporate level, NASDAQ, of course, cares about a barometer for every company that lists on the exchange. Again, not a business that I'm intimately familiar with, but of course it matters. When we think about, which most of your listeners likely do, vehicles where there are assets designed to track them, then it matters. Then people are putting capital to work. And of that massive set of choices that people have, the NASDAQ 100, people vote with their wallets. That too is a little cliche, but where is money flowing? And even when you kicked off in the beginning with the talk of crypto, right? That is there were years not that long ago where it was considered illegitimate, but people have voted with their wallets, and that sort of bestows some sense of legitimacy. So Nasdaq certainly cares, and there are hundreds and hundreds of indices that we track. The question ultimately becomes, are there assets linked to those? And then is there a need for derivative tools to manage and really customize that exposure? And in the cases of the NASDAQ 100, that is certainly the case, and it continues to grow.
Yeah. To me, it's more like I don't hear anyone talk about the Nasdaq Composite. So I get it's important over there, and I'm probably in a bubble, and right, all the options, everything, the futures we deal with are all on the 100. But
So here,
just
even I think about this often. And the comp does get it flows across chyrons on financial TV. But when I was younger, or our parents would be talking about the Dow. And I think there is a time and a place for indices. And I think they reflect to a certain extent the zeitgeist. And that is my sort of longer term belief in the ascendancy here. And that is not the case now. I'm not on here saying the Nasdaq 100 is the benchmark, but when you watch the evening news or whatever, go through your TikTok scroll, wherever the news comes from, it's not highlighting the Dow. And
No.
that's not likely to happen at any point in the near future. And there's a reason for that. Like our tastes change, asset flows move, and we are in and change is constant. So we'll see what shakes out in the future.
I was golfing a couple weeks ago with some guys, and the guy would like looked at his phone. He's like, "Oh, the Dow is up, blah blah blah." And we actually three of the other guys were finance guys, and we started making fun of them. We're like, "Are you 80? What do you mean the Dow? Who cares? What are you
He
talking
caught
about?"
that on his AOL
Yeah, exactly.
messenger.
Well, then to the point, he probably has money in something linked to that, or some perception that that is going to affect his investments. And as those investments, transition through the generations, if those are going to be folks my age and younger, that
Yeah.
same conversation. I'd like to be at a point where we're 50 years old on the golf course and being teased at Nasdaq 100 is.
Yeah, what?
It was so popular 10 years ago. That would be great.
But that leads to my another question of it. Is it become so normal, right? It was the hot upstart, the tech, you're going to get more return, more volatility, all these pieces. A lot of the options were traded because of that. Like, here's where you go for some of these more complex option strategies, which need the volatility. Does it become so mainstream that you lose that character of it, or has it already? I haven't actually. I don't know if you guys, I'm putting you on the spot. Like, has the volatility come down over time? Have the total returns come down over time? To me, I don't
I'm,
think.
I'm gonna tee Kevin up for a 90s music point. Is Oasis
Yeah.
any less cool just because they were huge? Like it.
Yeah.
I think it's totally okay to be mainstream and still providing that special sauce. Kevin, what do you think?
Man, Nick, you got me with that analogy. I appreciate it. I think I would start by going back to one of the points I made a couple minutes ago about it's a very different constituency. It's a much more mature constituency. But I would also argue, given the makeup, given the construction, given that sort of index recipe where there are 100 constituents, not 500 or 2,000 or the Wilshire 5,000 or however many are in there, it will almost certainly, I always use hedge language, be more volatile at the index level than something with
Mm.
a broader basket of securities. Now, putting some numbers around that, because a lot of your audience is probably
Right, I can put a
quantitatively
muni bond 100 and probably get less volatile.
sounds fun
Yeah.
and
But
tax advantaged. So over like the past 25 years, that realized volatility spread on an annual basis is just over 3 vol points. Now, what's interesting
over the S&P, you're saying?
correct. Yep. So we're talking
Like,
like
on average, it tends to stay right there?
no, that really good question. That ebbs and flows. It gets about as wide as 8 vol points, and there have been sort of 1.5 situations where NDX vol was slightly under S&Ps. I'm going to put you on the spot here, Jeff. Just if you had to take a guess when that might have been, what would you think? And it wasn't for a very long time, so like I don't think you're not gonna look silly.
Microsoft was added to the S&P?
It was
Someone like that? Yeah.
so I got stories around something like that too. The answer as far as annualized vol is 2009.
Mm.
So my thinking there is like the X financials part matters. And when you think about that period, very much of the risk was centered around that area of the market. Now, most certainly bled over, right? We're certainly simplifying here, but the sector that was most directly impacted was financials. Financials have lagged for decades on like a relative basis, and they now make up a smaller part of the S&P 500 than they have in a really, really long time. Um, you make the point about when something was added to one index or the other. I'm going to turn it around on you again.
Oh, boy.
Tesla. It was added to the Nasdaq 100. Take a stab.
When was it?
Yeah. Just a year.
2017.
2013. When was it added to the S&P 500?
2017.
2020, the very end.
Yeah.
Now, a ton of market cap growth in Tesla was captured between 2013 and 2020. And you could pick out a number of names, maybe not quite as magnificent as that one, to coin the today phrase. Taking it back to our sort of bigger vol point, the spread post-COVID has been on average 5 vol points. Now, that might be even bigger than you probably would have guessed relative to that long-term historical norm. This year to date, annualized vol in NDX is 25.5, and in the S&Ps, it's 20.7. So very much in that sort of 5-year average. The widest it got in recent memory was 2022. And if we think through that, the sell-off in the market was very much concentrated on mega cap tech. Names, big household names, went down 30, 40%, some more, and it played out with higher vol. It is a feature, not a bug. And I think it drives a lot of the activity that we see in the derivative ecosystem, that volatility and higher vol is the appeal. I could be wrong, but I feel pretty strongly about that.
And
But Kevin,
go ahead, Nick.
just back to the conversation you and I had, Kevin, in terms of like directionality of vol and the market movement, I suppose it just springs to mind that, of course, you know, when we look at assets, we're looking at it through the lens of derivatives, which can be from a hedge scenario. Of course, when the sort of the underlying investors look at the assets, it comes more from the perspective of what's going to make money. And then you talking there about how, you know, if you were invested in the Nasdaq 100 through that period of 2013 to 2020, you were making money in Tesla, you weren't on the S&P. I don't know. It just got me thinking about what all that means for vol, which I suppose inherently, you know, is not an upmarket metric per se. So it's an interesting time we're living in, right?
Well,
Technically it is, but we don't think of it or quote it that way. Yeah.
Right.
You nailed it. That upside vol is a thing in our world, and it is a thing in the calculation of annualized volatility. You think back to the early April move where markets ripped higher post, you know, we should be buying stock talk. And the Nasdaq 100 on that day was up, I believe, 12.5%. The S&Ps were up in the ballpark of 8.7%, something like that. That is a move, a close over close move that stays with volatility measures for quite some time. And what we have seen over the better part of the past decade or two is that upside vol, that the Nasdaq 100 is as reflective as upside vol as anything, but it does cut both ways because, like I mentioned, 2022, that is the downside. But for passive assets, the ultimate sort of goal is performance. And so that, by that measure, it's going to be really hard to choose an index that has outperformed the Nasdaq over any significant time frame.
Do you think some of that is U.S. based too, U.S. centric, right? Like if you zoomed out even further, U.S. over Asia, U.S. over Europe has been dominant. So part of that story to me is not just the tech piece, but also the U.S. piece of the Nasdaq, right? It's got less global probably than S&P.
Fully agree with sort of the articulation of a zeitgeist that expands beyond just S&P, Nasdaq, or Russell S&P or Russell Nasdaq. That has played out since, let's say, 2006, right? When like the BRICS sort of countries were ascendant. That could change. I'm, like, you know, Jeff, kind of a fan of history, and it can be dangerous to think this is a new normal. The makeup of the Nasdaq 100, there are a handful of international constituents. I can't just rattle them off the top of my head. And in terms of revenues, the proportion of index revenues that come from overseas, Nick, this is something you and I believe we're talking about, is
Yep.
actually higher in the Nasdaq 100 than in the S&Ps.
All right.
And
And I believe
that,
it's 50% now, right? Over 50. Yeah.
correct.
But is that weird because Apple's routing it through an Irish subsidiary? It's like things like that.
I
I'm
would
sure
say
there's
that's
some steer.
probably, yeah, they are doing that, in biotechs as well, right?
Yeah.
They're not the only ones, and being smart within the confines of the law with tax burden is just be smart business, right? I'm not here to prosecute that, but
I see.
Go for it, Nick.
I was going to say that I suppose when it comes to, we talked about Nasdaq 100 being the index of picking winners, essentially. To summarize your earlier point, Kevin, is that, I mean, the export market is part of what has led American exceptionalism. American exceptionalism in equities is not a vacuum story, and so to go back to, and granted, looking at it from a linear upside investment stance, even though derivatives provide a whole lot more exposure to that, yeah, it kind of makes sense that's how folks want to make money off the equities that are going to make money off the world. That makes sense.
Yeah. Who owns the IP, basically? Two thoughts here. One, my personal investment philosophy is as soon as they come up with an acronym for it, it's time to sell, right? BRICS, all that stuff.
AI as well. AI.
Yeah, I don't know. No, AI is fine. That's more of a
what does that leave in your portfolio these days?
Yeah,
if I
nothing.
have to be a devil's advocate, what do you
well,
got?
you can
Campbell's
add
soup?
something back in later, but right as soon as it becomes like, oh, BRICS was the perfect example, and then they
That's a
changed.
good point. When they've come up with the acronym, probably all the analysis has been done by the smarter guys who have more information behind you, rather than what you can do in your portfolio today. It's a good system.
And then a note: we've had guys on this podcast doing tail hedging that they actually will look to the Nasdaq options because they feel there's a little hedge in there. If there's a shoot up, that vol's not going to just erase like it will in the S&P. They might get a little pop in vol, right? It's not going to be a big payout, but it might hold up value more than you would think in a huge up market.
Nick, you should be talking to those types, and have at it here.
Yeah, definitely. I mean, yeah, we agree. that's what we do. I suppose from a tail risk perspective, I would like to think of this, because now we are getting into like managing that volatility, essentially, not just what do we like in the index, and why do people like this in the index, a little more derivatives focused, and then specifically index options focused. I mean, for me, coming at index options, I joined Nasdaq 18 months ago from Eurex, which is a whole farmyard of different derivative classes and types, and across fixed income, futures, options, repo, the like, and diving into a single product that Nasdaq offers has been a fun endeavor. And for me, just to explain kind of where I'm going here, is that index options provide this very specific opportunity, insofar as the asymmetric investments, one, but then I was saying to Kevin that I find the paradox quite interesting, how the proliferation of the specificity of the expiries has occurred in this machine that inherently is kind of broad based. So you look at what risk am I exposing myself to, and this is what I find fascinating anyway, is that in index options you're looking at, okay, we have this discussion, we might be on an investment committee talking about what put option are we going to buy. Let's just boil it down to a simple scenario, and we have the discussion about, okay, well, where is our investment, what are we looking to hedge? But then I think what is most fascinating to me is just how these broader indices, we're talking about different time periods. So then to be able to segment and slice up is not something that you tend to do in the futures world so much. Those tend to be roll positions, for specific management of specific, deliveries. This is more about, okay, what am I hedging against? And that is what attracts Nasdaq 100. What attracts the Nasdaq 100 for me is that these tail risk scenarios, we often look back at what were the tail risks, and we talked about financial crisis 2008. Okay, that's a big one, and of course, although a financial crisis would have a a big impact, surely on the Nasdaq 100. We can dive into, for example, the differences in the average debt ratios in the Nasdaq 100 tends to be higher, for example, than S&P 500. But by the by, the financial names are not included in the Nasdaq 100. So then we start to look, okay, what are the contemporary tail risk scenarios like DeepSeek Day? Is the scenario that we're hedging against truly a question of whether the 400th to 500th constituent of the S&P, maybe sort of old school industrials, are going to go down 10%, or is it that Nvidia has a particularly bad day? And if Nvidia is making up such a large portion of my portfolio, that's something to consider.
Yeah, I'm 100%. We run across these investor types all the time of like, oh, I'm trying to hedge my portfolio. I'm looking at this S&P tail risk. And what's your portfolio look like? Right, and it's basically the Nasdaq 100. It's Nvidia, it's AI, it's Apple, all these things that have increased greatly in value. So yeah, I think
there's
that's
still
the point you're making, right? Like, hey, make sure
exactly
your protection matches your exposure.
The
makes sense.
one
Yeah.
the one other point I would make, and it's getting a little bit wonky, but I think most people would follow, is that in the derivative markets, the natural supply demand dynamic is always going to matter. And by and large, most tail risk strategies are expressed to this day in the S&P 500. And you could make an argument that the tail volatility, so there could be any number of options that fall into that category, but let's say like a 10 delta or less option with 6 months until maturity or more, right? Wing options, that the demand for those as a function of vol control, tail risk strategies pushes up that sort of relative value of the S&P put, and you don't see the same natural demand to date in the Nasdaq 100. And so we have looked at some of the data going back historically, and on a relative, you could make a relative value argument that if we have that event, that catalyst that drives the S&Ps down, I'm just picking a number, 20%, the Nasdaq 100 would likely be down 25%, something in that neighborhood, and that the vol performance of what would then be the at the money options in both would be more responsive in NDX. So I think it's a longer winded story, but I think we will through time see flows of the tail risk management variety that are increasingly expressed on a relative value appeal in NDX. Have seen, sorry, I'll leave it at this, but a proliferation of insurance firms looking for lit markets in long dated NDX maturities. And that is because they are seeing demand from, I want my reference asset to be the NASDAQ 100, and I want some parameters around that exposure. The lit market is then informing the OTC market, and you see that risk recycled back into OCC cleared products like we support.
Can you explain the lit market for my friend George?
Sure. Yeah. So anything that you could pull up on your trading front end has a lit up, a visible bid and ask, right?
So it's call around business and finding a market. Yeah.
And then there's the OTC or dark pools in the equities world, and that is an opaque market. And beyond that, it's not centrally cleared. In the, knock on wood, unfortunate scenario that something like that becomes a concern. And so the liquidity providers are lighting up a value based around some theoretical value for the rest of the world to see. And I think that a great deal of OTC risk is at least using that as some indicative pricing to manage these longer dated exposures and the risk around it.
Any millennial and Gen Z listeners, the market is also lit. It's a fun place to hang out, right?
Yeah, exactly. The lit market, man. Um, that's some Miami lingo you got going. Is part of it, I don't know the numbers here, but it's probably more expensive, the NDX option tails, right? To purchase. Like, so they're going to be more expensive, which people just, it's like a cheap hedge. Like, I'll sacrifice I'll take on some basis risk to save a little money paying this annual expense on the tail hedge.
Nick, do you want to take that one, or you want me
Yeah.
to?
Yeah, I mean, essentially, that's not inaccurate. There's going to be costs associated with that. Ultimately, it's the cost per, volatility exposure that you're getting in that, and of course, that is higher for a higher volatility index. I suppose that speaks to Jeff, the other use case of, and Kevin alluded to, insurance companies that offer annuities. Various structured products go around this where there are income strategies, and that will be kind of the counterpoint to what we've just been talking about in terms of the validity of these tail risk hedges. Not even counterpoint, but just the other side of the coin is that, if you're looking to generate income from the index options market in selling these options, then there are possibilities in the NDX. Kevin,
Right? If they're too expensive, sell them instead of buying them.
So
Yep.
when you make an expensive or cheap argument, it is relative to something else, either itself historically or some other asset. And the one thing that I would point out as certainly an appealing element of a notionally sized product like we are supporting is that the with one put option, for example, you are theoretically offsetting the full value of the index, which right now we're talking about a 2.6 million. So the ratio, my point here is that the ratio of NDX over SPX continues to widen. And so with fewer contracts, a hedge fund or an insurance firm can offset the same notional exposure using NDX as opposed to SPX. And so if you notionally equate the premium dollars, they're probably very much more similar than we're sort of alluding to right now. In pure premium terms, NDX is a rich contract to trade, and you need to have your big boy pants on. That is why we see predominantly spread trading going on, because outright exposure is very, very costly.
Yeah, and I'm blaming some naive people who just see, oh, I have to spend less over here. Like, I'm gonna ignore all the upsides and all the notional. I'm gonna ignore everything else, and it's just I have to spend $500 versus $1,000. So I'm gonna spend 500.
What that's how consumers work, right? Like that
Exactly. It's like,
happens all over the place.
so we bounced around. We've touched on flows a little bit, a couple of times. So a few things, no particular order. I'll throw them all out there, and you guys can tackle them as you see fit. As you mentioned, all of these buffered notes, structured products, all of that flow coming through into the listed option space. The proliferation of covered call strategies, which are somewhat related, but a little bit different in my mind, and then the zero DTE stuff. So, who wants to jump on which grenade first and kind of talk about what you're seeing there, and is that as big as I've seen reported, and is it growing substantially?
I'll start and then flip to Nick, but those are not grenades. Those are growth bombs.
Lollipops? Yeah.
I mean, they are boxes that just keep getting bigger. Now, from the seat that you're in, you want the business where those flows are then ultimately wrapped within the ETF structure and offered out and available. But behind the scenes, what's going into that box? And this too, sort of going back to the how consumers behave, is exactly what the market needed in my mind. So many people don't want to manage the nuance of I'm comfortable with long outright index exposure, and sure, I would love protection against the first 10% in downside, or I would love to potentially participate in some of the upside. Now we're talking about covered call, structured sort of overwriting, and I will give up some beyond a point, right? but they don't want to go into their XYZ account, manage that, roll it, deal with the tax implications. They want a simple wrapper. And this made all of that available. And the market has voted with their wallet and put hundreds of billions of dollars into these wrappers over the past handful of years. My belief is that it is still very much early stages. And that is that belief is sort of pinned to the huge number of assets that are traded in structured products. You are seeing all the sort of flavors that are available in the structured product world come to the ETF wrapped world. And it is a good thing, I believe, for the market. Now, that said, that doesn't mean that every wrapped product is a good one, because I think you're seeing some sort of that leverage is typically at the epicenter of things that unwind in an ugly way. And if you don't appreciate how much leverage you are assuming in a given position, that can work out very poorly. But for the judicious, really well informed investor to be able to get that exposure in a tax efficient wrapper and not worry about all of the nuance, I think it is a very, very good thing for the market. I think that incentives have been aligned. And when Nick is out talking to hedge funds and stuff, I imagine they find it a little bit more difficult to position their sort of value prop, given the proliferation of sophisticated product available in a very simple wrapper now.
Yeah, I fully agree on all that. I would say that hedge funds are still doing what they do for who they do it, and doing it well. There's I would say that you also have to think about it from the lens of, and the example that sprung to mind, Kevin, when we were talking there, was I'm on the board of a food pantry here in Coconut Grove in Miami, and we have a small endowment, and you have to think about it from the lens of when you might have sort of a lot of endowments have fully staffed investment committees of finance professionals. A lot of endowments don't. And in aggregate, those smaller groups, we have to go through that education process with the board to understand, what are we investing in. And I think the advantage of Buffett notes in particular is that it strikes the balance between easy enough to understand and invest in without being excessively complex and creating what would be perceived as risks to a group who maybe are looking at the funding of a food pantry over a period of time. So we don't want to be in that very tail risk scenario. But we also do want to participate in the upside because we want to still feed people 10 years from now. And so that becomes an investment that makes sense, and historically would have probably been fulfilled by some combination of blue chip stocks with dividends. And so it really isn't a new model. It's just a new way of folks accessing that in a way that I think makes a ton of sense. And certainly we do as an endowment. So,
and now you are the bakery selling these donuts, so you might not have but to me it's like become so popular, my cynical brain's like, something's going to break, right? This is getting too big. When the other foot falls, what's it going to look like? And then I realized, well, if you just a bunch of call selling, it's just going to look like a bunch of people only making 20% when they should have made 40% or something like that, which maybe after enough years people start to say, hey, this is stupid, I'd rather have, maybe not.
Yeah,
right?
you adjust.
Happy.
But sorry, I remembered the rest of my point I was making to Kevin on the hedge funds. As you have these instruments that Jeff talked about there, that are providing certain returns that may or may not be suitable in a given moment. I see that as like building blocks to the pyramid of you have more sophisticated investments up top for more sophisticated needs, and the proliferation of bank QS desks that provide those sophisticated strategies for large institutional clients, not the Coconut Grove Crisis Food Pantry Endowment, but instead a large pension fund. I don't think that those are unrelated. I think that that step up in sophistication is actually combined, because those guys are on those endowment boards as well, as everyone gets more involved, it actually just brings it all up. To your point, Jeff, what is the tail risk of these of these tail risk protection strategies? And I think that we would just see a reset of how folks would want to invest. But the same has been true of, like, you look, when do you dip your toe in crypto?
Yeah.
When you see those investments going up a certain amount,
Yeah.
and when's the moment for that? So, for me, and my love of derivatives as a market is that it just provides all these options, forgive the pun, for investors, and the increasing amount to which those are being made available across the board. It's just a wonderful thing.
Well, Jeff, you made a point that I think people that have been in and around the market through a variety of crises are want to make, and I'm very much the same way. And then you answered it well, like in the example of the covered call, we're talking about strategies that have a beta of like 0.65 to zero point 0.7. Now, contrast that with something like the implosion of levered volatility exposure, where it's 2x
Yeah.
of
At least. Yeah.
exposure, right? Or, and I'm not trying to pick on any specific name, but like a 3x MicroStrategy. And these are not things that are designed to be held long term, but do end users understand that when a performance chart looked like short vol through 2017? It did exceptionally well until it didn't. And understanding that what's going into my wrapper is crucially important. The one other thing that you teed up a couple of minutes ago that we didn't address, which is another sort of market structure question to a certain degree, is the real appeal, the volume generated by expiring options, by short dated options these days. And that's one where I think even the most optimistic of exchange veterans probably would say, "Wow, this has grown beyond what I had anticipated."
For one, for
But
the reason of like we've always had options expiring today. Like what's the big deal? Like we've always had options that have 0 days till expiration, but now
we
they're
we
every day. So yeah.
yeah, but the I keep going back to the sort of consumer markets across the board, and people value customization or precision. You think about like shoes. When we grew up, there's just like a handful of shoes that were available, and now you can legit design your own and have them delivered in like a week. It's amazing. The other thing I think about, and I'm going to bring it to sports right now, is your son playing golf. My son, I'll go to a baseball game later today. He arguably, like some people could argue, they spend too much time on the range, playing golf, playing baseball. It's repetitions. And I would say if you are able, as a newer derivative user, to get those reps in and to get regular feedback from these short dated options, where premiums are smaller, where theoretically your risk is smaller, it depends on the strategy, big time caveat, but you're getting feedback from the market, what's working, what's not. That's sort of like practice, practice, practice. And if you're only able to play one game, I'm making it too simple here, a month, you're going to get better through time. But if you're able to play 20 or 21 typical trading days in a month, you can probably fine tune a strategy much more quickly. And maybe I'm oversimplifying there, but I think that increasingly market participants are seeing value in that ability, that combination of precision, sort of customization, and regular market feedback.
And I've guys on the pod talking about the mathematics of it. Even ignore learning. Just if I believe I have this minuscule edge, I want to run it back as many times as possible, right? So the mathematics support that. which
And then
is
the other thing about like reducing your path dependency, right? If you had a big move on the third week of the month back in 2005, your passive strategy would be really impacted with something that you're able to do either weekly or daily. Your path dependency changes significantly.
and
It's kind of cool
go ahead,
because
Nick.
in the zero DT world, we created this. I mean, we count the contracts as an exchange. Like that's how we make money is exchange fees, right? For the contract. So we don't always, on our balance sheet, profit and loss, we don't differentiate. But of course, the nature of those instruments is so wildly different, whether it's expiring, in 10 minutes or whether it's expiring in 10 months. And so I think that you know, you could logically, and many research departments do isolate those expiry flows into specific analyses of okay, what's being done, and it's a completely different market, different set of people doing a completely different set of things with a completely different set of things, even though the tick is the same on Bloomberg. The Greeks can be completely different, the speed of move is completely different, all of those things are so different, but I think it just speaks to the beauty of derivatives again. That's the specificity of exposure. Not only can we provide you that over a period of time, but also 5 minutes from now.
In my brain, these for-profit exchanges are just going to keep going down that rabbit hole, right? Of like, hey, let's do half-day options, let's do hourly options, let's do right. Like, why not just keep getting shorter and shorter time frame? At
Yeah,
some point, there's going to be right. Ask you guys, what's the practical limit of the innovation there from the exchanges side?
The thing I would say, and I am not privy to any plans like that. I understand your point from like an MBA analysis of what drives the bottom line. And just to be clear, that would probably be good for a group like yours, like more things on the menu, right? Where we benefit. I don't think that's exclusively how exchanges look at it because we are sitting between a variety of different players with different motivations. Beyond that, there are technical concerns. So if you think about liquidity providers and the amount of quoting that goes on, given the number of strikes and products we have right now, it is pretty remarkable how efficiently our markets operate. I think there's something like on an average day in Nasdaq options exchanges, 100 billion messages. That's beyond what I can comprehend because I've not been in that.
oh, can't print it out, right, Kevin?
So
And no blockchain was needed. Remember when blockchain was going to solve that? And anything that had that many, like, no, we can just do it. We're good.
Can I? I'll speak, Kevin, unless you want to finish up. From a transatlantic lens, I think I've become increasingly cognizant, and I had this debate with a colleague of mine from Sweden. Hey, Håkan, if you're listening, and he was saying that the 100 decimalization of everything is the way forward, and we should decimalize time. Like he very very strident on this. Had his logic, and I guess I'm only sorry that he's not here to defend himself. But my point is that there are suitable measurements for everything, and it comes down to actually in the end biology. Like ultimately a day makes sense because it's light outside for a period of time and then it's dark outside for a period of time. 24-hour period is a logical period, and that's the sun. Similar story, like when it comes to American and European measurements. European favors the logical. It says, okay, you have 1 gram, and then you have 100 grams, you have so forth. And was it 1,000? Was it 100 milliliters? 1,000 milliliters is a liter, and then a liter is a kilogram. Yada yada. Right?
We'll put in
American
the Nate
favors.
Bargatze
Yes, thank you.
weights and
Put it in the show
measurements
notes.
skit. Yeah.
But the American favors the practical. And you open a recipe book in Europe, and it has grams, 100 grams. Now that works if you're going to the supermarket to buy something in a 100-gram number. But American says cups. well, everyone can just buy a cup, and then we all know cups, and then cups it's slightly less accurate, but from a practical lens, it actually makes a ton of sense. And the one that I've always found funny, and I, to this day find amusing, is that when I came to America, I realized that the gallon price, which by the way, a gallon is a logical amount, it's like this much, right? Again, back to the point, like,
If
okay,
you say so.
and that's an ounce, so forth. But the gallon on the price of the gallon on the pump was how many miles I drove per gallon. In England, we're weird, and we have, miles per gallon is our fuel economy. We buy our gas by the liter. So I always had to do the math. And then I came to America. I was like, oh, 25. How about it? That's how many miles I'm going to. So anyway, where I'm going with all this is just that there is a practical limitation to a lot of things, and it's organic, and America happens to be at the forefront of that as it relates to measurements. And we've said no, we don't want to do metric, but for this purpose, there every second wouldn't make sense. We can't do things in a second, so there is this logical.
Who are those traders? Who's like,
extent.
is anyone demanding that they get shorter and shorter?
Well, I'm sure someone is, but again, it comes down to like how practical is it for most people, and to Kevin's point, how practical is it for the market makers in question? Anyway, I just enjoyed that as a conversation, as a transatlantic person.
So in England, you still have miles per gallon for your car, but it's liters. So yeah.
Yeah, we sort of awkwardly straddle without.
But it's so expensive anyway. Like, why even do the math? Just like, this is too expensive. Take the train. Couple more things. AI, generally, what is Nasdaq doing anything inside of the exchange with derivatives, with AI to, like you were talking about, to transact those billions of transactions or whatever? And then more generally, just what are your guys' thoughts? We talked about what are those tail risks, like if there's another deep fake or AI kills somebody or who knows what's going to happen, right? Is that the next tail event of some, right? Or some couple Fortune 500 companies go, this isn't working for us. We're pulling back on all our AI spending. So maybe let's start with the second one.
No, I'll let Kevin think about the second one while I answer the first one. So Nasdaq, of course, as a exchange, but also a fintech, is implementing AI, and AI. And coming this from a derivatives lens, I'm sure you've had guys who operate CTAs, do machine learning. Like AI from a trading lens isn't necessarily a new thing. It's just the speed at which things can be changed and rechanged and done and all that jazz. But machine learning has essentially been there, and it's kind of the nature of software. I suppose when I think about software as a service, I'm thinking about like functions that we can get computers to do that historically humans did. I wish I had it with me. I got a book, fantastic book, After the Trade is Made, David Weiss. And it's written, I think, late 90s, and it shows all the securities processing functions that happened. And these used to be rooms of people, and it has these wonderful diagrams where you can see all that. And it's fun. It's fantastic to read as someone who's kind of new to the industry because, or new, from joined since the advent of computers, should we say? Because a lot of those functions still exist, but they're done by computers. And the reason that they're done by a computer in a certain way is because a human used to do them. So anyway, I just think it's interesting when you look at software and the way that that's gone, specifically when it comes to teaching software to teach itself, which is how I conceive that notion. Nasdaq, from a exchange perspective, we have to choose what strikes to list. So when it comes to NDX, we have all the strikes. When you go on your option chain, you can see the different strike points that you can pick for the strike on your options contract, as well as the expiry, the strike and the expiry, and the call and the put, the buy and the sell, give you your sort of definition of the contract. So we don't have strikes from 0 to 10 million. That would be too many messages, to Kevin's earlier point. So we've implemented an AI system by which we can sort of align the supply and demand and the likely supply and demand of those strikes, so that we're being efficient as a provider of this infrastructure, and keeping our servers cool, essentially, so that when there is a specific interest in a specific strike, not only is that strike listed, but also then we're ready to do it. We're not wasting money on wasting server space on the stuff that isn't being used.
So you're the guy I need to call when I'm like, where is this strike on CoreWeave? Why isn't it here? Yeah.
Yes, and certainly, there are requests. Kevin talked earlier about like insurance issuers asking for not essentially strikes, but expiry listing at a
Mm.
further place. But yes, indeed, if anyone's looking for strikes, feel free to get in touch. But for the time being, we have a system that deploys AI to facilitate much of that. And then, of course, Nasdaq more broadly as a sort of fintech organization, we made acquisitions of Adenza, Verafin, other fintechs that deploy AI in their solutions. That's not so much Kevin in my space, but big part of the Nasdaq corporate strategy.
A lot of early AI in terms of markets was used for like compliance too, like no market manipulation and fat finger stuff and all
Yeah,
that stuff.
rightfully so. Yeah, exactly. Picking up on whatnot. And your second question was around, what does the next stage of AI look like, and or could that be a challenging scenario, should we say?
Yeah.
Kevin, I
I'll
wonder
throw
if you have
one
any
more.
thoughts there. Or go ahead.
I'll throw one more piece to that. Is my theory is we're going to AI ourselves into a huge recession because we're going to take away all the consumers, right? Like this whole two
But
buildings of people that had to create that market structure you're talking about now does not have a job, or they have different jobs.
well, this isn't our first industrial revolution, right? That would be my first thought to that. Is that you know, sure, those factory jobs, and I suppose you could even think about it in terms of Nasdaq 100 as the index of the factories at the time
Yeah.
of predominantly agricultural development. Um, to me, that was not a inherently bad situation for most people. People reskill, they retool. There are jobs for people. They may look different to what they were before. I suppose to me, the main advantage of AI is that I think retooling can you can never argue. Well, you can't. I don't think you can argue that retooling has been ever faster. You can take someone and retrain them in something different if they have the skills to use AI in their new line of work. I suppose is kind of where my head goes to, and then fundamentally, uh, the same number of restaurant staff. I mean, where are we going to take this? Ultimately, people. I suppose this comes back to the practical limitations of the economy that we talked about in terms of like how short should our expirations be. I would say that ultimately this whole wave of technology is still in the advancement of human beings, and we need places to live and cars to drive and places to spend money and food to eat and all of that, which is an economy in and of itself, which can be sped up by AI. But you know, it's going to be a while before that is a wholesale replacement, and we never have any. I mean, the scenario I suppose we're talking about is having no interactions with humans ever. That's not what we want, so it's not going to happen. Kevin.
You guys went very sort of philosophical, and I think I'm sort of two minds on that one as well. The only thing I don't think you brought up is that like industrial revolution that needed at some point in in the process a pushback. And so there I'm thinking about things like labor rights. And so the regulation that exists in US markets is one of the reasons I think it has become the epicenter of financial markets generally. There is trust. And so long as we are able to advance this artificial intelligence effort and people continue to trust the output, then we're doing well. And it's going to require some type of governance to keep it on the rails. Jeff, your sort of original point of the what if we can't monetize this? I think it's a very real risk because there's not been we don't have a long enough track record to say here's how you manage through a crisis. And ultimately our economy is still dependent on my spending, Nick's spending, your spending. And
My what?
so the cannibalization of
She doesn't
jobs,
listen.
right? It's easy to tell some dude from 1842 he needs to retool. It's a lot more difficult when you and I have to do it. And so those are legitimate concerns. I don't know where they go, but the can we monetize it, I think, is a real linchpin. I wish I could answer. I can't. But if there's a tail risk event, I think you might see more responsivity in NDX options compared to other alternatives.
Yeah, look at them put the bow on it. And related somewhat, and I guess your thoughts, has the net, are we more top heavy now than we ever have been? Has that always been a feature of NASDAQ 100? Is S&P trying to catch up and getting more top heavy to look like the NASDAQ 100? Sorry,
So
three questions in one there.
the
Are you
there
worried about the top heaviness, and is it all that different than historically? Is the main question.
uh last thing first. Historically, I would say that a market cap weighted index, unlike the Dow,
By definition.
inherently favors some sort of top heavy makeup. That we vote with our wallets and the big ones make up a bigger portion. It has worked. Relative to history, it is not that different than any other time. We're talking about degrees of like, is it 22% in the top 10? And now I am talking about the S&P 500 versus 29%. And is there a tipping point? Ultimately, it is very typical for a handful of securities to really pull along the rest of the market. And the same thing happens on the downside. They can bring them down. That those securities have had a greater concentration or exposure in the Nasdaq 100 over the past handful of years, and that has led to outperformance. Now, if you look, because we talked a bit about global markets, our concentration is much smaller than what you see in the likes of NIC's FTSE 100 or the DAX, where just a handful of companies
Yeah.
securities dominate the market, and it still works, but like the market cap of Nvidia is still bigger than the entire FTSE 100 market cap or like the DAX. Our approach is working. Are there risks? Most certainly. Can they be managed? I would argue yes. But I think big picture that markets are bought and sold, and we like to lean into the greed side and we like to sell the fear side. And I think mostly the concentration stuff is written with that fear motivation. I'm not
Right.
scared.
Can I add that like everything's always top heavy?
It's a winner
Walmart
take
makes
all
more.
world.
Well, Walmart makes more money on one thing than another.
Mm.
So if you have an index of companies that look exactly the same and perform exactly the same, it's still top heavy, just in a different way. It's top heavy within those equities. So it just happens that this is a top heaviness expressed separate with an outperformance, to Kevin's point, of supply and demand, and then demand in that particular equity. It just happens that Nasdaq as an exchange has the equity listed that people want, and the price reflects that. That could also be that people want a portion of a specific stock and not another. So I suppose, yeah, top heavy at what level? I know your question is quite clear in nature, but I would argue that there's always going to be winners and losers, even if that's possibly internationally, possibly even in a microcosm of a particular equity.
And
And the
didn't we
losers
say
get cut at the end of the year. The losers get
True.
cut.
uh and that's formulaic, or there's a committee?
Formulaic in the Nasdaq 100, which again I would argue people prefer as opposed to some of the choice embedded in the S&P 500.
Yeah. I was just remembering as you were saying something that I think 2 years ago in the Nasdaq, where the dispersion trade was kind of upside down. The actual single names were having less volatility than the index itself. Am I mistaken there? Or that happens from time to time?
Well, you bring up a very interesting point, particularly right now, where something Nick and I were talking about over the weekend, realized correlations within both of the major indices we've talked about so far are at historic lows. That
Yeah.
means that idiosyncratic risk is what we're seeing. Stocks, you're getting in the past handful of weeks a legal ruling where Google and Apple were pleased and had big days, and you see these single names that are making big moves, but at the index level, by nature of how indexes are, it's balanced out, and we're seeing exceptionally low realized volatility. The dispersion trade has grown alongside, like the wrapped product we were talking about yesterday. That is something where I believe in time you will increasingly see the index vol component of a vanilla dispersion trade whereby somebody is long volatility in the constituents, short at the index level. I think you are going to increasingly see that expressed in the Nasdaq 100. I think the concentration, and there are so many ways you can carve up dispersion. I'm talking vanilla.
Yeah.
But like you typically do it with some subset of the constituencies, and you could Vega weight or whatever Greek weight you prefer, arguably easier with the Nasdaq recipe. And then,
Well, 100 stocks versus 500 too.
or you
If you
think
wanted
about
to do
even
it
in the
full, yeah.
500, they're typically doing 50 maybe of the
Yeah.
constituents. So you're talking about a tenth. And it has worked. I'm in Evanston, as I mentioned, and I've become friendly with some professors at Kellogg, at part of Northwestern, and they are doing some research specific to NDX as a dispersion expression, and we'll have something to talk about there next year if you promise to have us back.
Done. My theory is the other side of it. These companies, which the proof totally proves me wrong, but my theory now proven wrong is they become so big, they're like countries in and of itself. You said it's bigger than the FTSE,
Yep.
that you'd think their volatility would come way down and they would operate with all these different revenue lines, but no, they have one big revenue line. Apple, it still blows my mind. $1 trillion company can add
Yeah.
5% in market cap after earnings. Like, wait, what? How do people not know that? Guys, got any last good thoughts?
I think what's interesting is where Nick is headed and how globally interesting our index is becoming. So as far as I'm concerned, I write regularly stuff where like I gave you a flavor with the evolution, where I try to make these markets that can be a little esoteric, more approachable. And if you're interested in that, sign up for it. We regularly do public facing things like this. But Nick gets out and talks to institutional end users, and they are clamoring for time with him kind of globally. And God bless him for the number of flights he's going to be on in the next
Boy.
few weeks.
I got a little packed schedule.
Where's the most interesting growth spot there? Right? I would assume like Hong Kong and London financial hubs, but is there other stuff?
Yeah, naturally financial centers. London is a huge secondary market for us as it relates to New York, of course, being where we see the most action from an institutional lens. But it gets spread out in the US and then it gets spread out globally. I think the brand Nasdaq has globally, and that recognizability. There's a better word somewhere. Anyway, that provides a lot of interest into when it comes to more sophisticated investments around US equities. I think the script we talked about earlier, where Nasdaq 100 is becoming dominant, is kind of already playing out in other corners of the world. We get talked about when it comes to US equities, and that's the nature of all the things we talked about in terms of our constituents, and the liquidity available in a cash settled index option like the Nasdaq 100 and the strategies you can do off the back of that is definitely attractive to the global audience. So to complete the picture, I'm headed up to New York next. I'll be there for a little golf tournament. I don't think I've made the team though. I'm waiting on
Ryder
my
Cup.
yeah, I thought I was.
Nice.
Yeah, I thought I was a shoo-in, but okay.
Captain's choice.
Yeah, never mind. We'll figure that one out. Then I'm on. Then it's the Global Volatility Summit in New York. Then I'm on to England, spend time with family, and then I'm actually playing the second ever Ryder Cup venue, which how's your
Which
trivia?
was
It was the first ever Ryder Cup venue. Kevin,
St. Andrews.
Worcester Country Club in Massachusetts, and then the second ever Ryder Cup venue was Moortown in Leeds. So I'm from a similar part of the world to Alistair Mackenzie, and if you were building a golf course in the 1920s in the Leeds area, there was one golf course designer that you called, which was Alex McKinn. So
yeah.
I'm playing that one. Then I'm on to Taiwan, speaking at the Taiwan Futures Exchange Conference, and then Hong Kong for EQD, out to Korea, and then I'll be back for a quick respite for some more travel. But yeah, it's a fun little time. I'm taking my golf clubs with me. That's the important thing.
Love it. And I was hazing you guys before we got started off camera of like, you got somewhat of the easiest job in the world. Like, who doesn't know Nasdaq? Who doesn't know Nasdaq 100 and think they
Yeah.
need the options? Why? And there's tons of people, but right? Am I?
Okay.
You tell me, am I in the bubble? Am I just confused, or is it so well known?
You're not, but we are not thought of in the index options world. You brought the
Which we
point up
talked
about
about
the
earlier.
commercials and the cues. And I think there is an opportunity to wrestle back some of that sort of brand cachet, to take it in house, not wrestle it back. Their distribution channel is hugely meaningful,
Yeah.
but Nasdaq is becoming a significant player in the index options business. I don't think the corporate has been thought of that way historically. It has been ceded to Chicago names. And I think that competition in that area of the market is good for anyone involved. And so that is as much the message as anything. This product exists. You can manage derivative risk in a cash settled European product. You could certainly do it if you're willing to trade 41 times the number of contracts in the queues. And the growth that we've seen over the past couple of years is a testament to at least some part of that story resonating.
Worth noting, to that point, Jeff, exactly that, I do go out and indeed one of the conversations, oh yeah, cool, it's on my Bloomberg terminal. But ultimately what it comes down to is exchanges tend to have some, unique insight, a product roadmap, a development, something that we're tracking. And that engagement with end users of the product is really what drives the family of users, as it would back in the day, like providing coffee at an old school exchange. My great grandfather was secretary of the Bristol Stock Exchange, so responsible for many of the same things at a regional exchange back in England. But I digress. Point being is that there's analysis that we share on liquidity trends, flow trends, market data that we sell on open close positions, and so connecting the dots for institutional users there is really what I do. And the tipping point is just that I think a lot of folks came out of the pandemic looking for what's the new norm, what does it look like, well, where are we at now, all that sort of stuff. And since 3 years ago, our volumes have doubled, tripled, and our spreads have halved. And so
In index options?
in Nasdaq 100 index
Yeah.
options, and that liquidity becoming a sort of tenable mooring, as it were, is really the story of the last 18 months, 2 years, since I joined. And that availability of the product in a liquid format, being able to trade in and out of it in an economical way is really what has changed. And that's the message that I get out to folks. Like Kevin has content, I also have a weekly distribution email that I call my Nasdaq Nugget. If anyone would like to get on the Nugget, we tend to
Yeah.
share a little something that we've seen about, just a volatility, something that we've spotted, and we tend to share a bit of just a 1 minute read on that. So
I want some nuggets.
There you
I'm
go.
partly guilty. So now after this, you guys have won me over because I've put together decks and helped managers before. I'm like, why the S&P? Right?
Yeah.
Why hedge with the S&P? And the answer is always in the deck of like, well, that's where the world goes to hedge or something. Right? It's like
Yeah.
just the de facto where you go, which is
Changing
kind of a
default
weak,
behavior.
but that's kind of a weak answer, right? Of like, oh, just because everyone else is doing it. But yeah, and then it's a tipping point, right? Like if everyone's doing that, it's hard to get a foothold. But once you get a foothold, now there's real conversation. Like, well, okay, yeah, it does make sense. That's my exposure, like we talked about earlier. So you
You're
won me over. Good work.
wonderful.
One
Well worth
down.
the time.
Yep.
One down. The rest of the world to go. We're up to it.
Awesome, guys. We'll leave it there. Thank you. Good luck to your son in his baseball game this afternoon. Kevin, Nick, I hope your team loses at the Ryder Cup. Wait, well, who are you cheering for now?
I will be cheering for Team Europe, but that's because I'm a West Brom fan and an England fan, so I'm
Are you gonna have a full
cheer for the
kit
underdog.
on and be getting hazed by all the rowdy New Yorkers?
I'll be quiet.
Careful. One of the coolest things I've ever seen. I was at Butler. Was it out here with the last Ryder Cup or 4 ago, whatever that was?
Medina. We're really talking about Medina? Okay.
Medina.
When Europe won. Yeah, okay, sure.
And I was on like the 15th hole, I think it's par 5, up by the green. Rory hit his second 3-wood, bombed it into the greenside bunker. And he comes walking up and we're standing there all excited. And these guys have these plastic horse heads on. And they're like going, Rory, Rory. He started dying laughing. He came over and he high-fived them and he signed some stuff. And he was just like totally relaxed. And then I was watching him and he just all of a sudden something clicked in his brain. He went into Terminator mode, just smiled, complete went off his face, walked in the bunker, hit it like a foot, 2 feet away and made the putt. And they went on to win. So congrats. But that was the most impressive piece of like human emotion.
Zen achievement. Yeah, exactly.
Sounds like you'd be a good risk manager.
Exactly. Right.
There it is.
Awesome, guys. Thanks for your time, and we will talk to you soon.
Wonderful.
Thank you.
Thanks for having
Safe travels.
You've been listening to The Derivative. Links from this episode will be in the episode description of this channel. Follow us on Twitter at RCMAlts and visit our website to read our blog or subscribe to our newsletter at rcmalts.com. If you liked our show, introduce a friend and show them how to subscribe. And be sure to leave comments. We'd love to hear from you. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of RCM Alternatives, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations nor reference past or potential profits, and listeners are reminded that managed futures, commodity trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors.